All right. Hello and welcome to the Accredited Investors Only podcast presented by Accredited Life. I am your host, Peter Neal. Welcome to another show. I'm excited that you're here with me today. We have a great guest with a great show lined up. And before we get into that, I always like to ask, are you living your accredited life? Here's the thing. Living your accredited life and being a successful investor, being wealthy, it's not just about the numbers. It's not about how much your net worth is or how much you have in the bank account or how much you have invested, what your assets under management are, or how much cash flow you have, all that kind of stuff. Obviously, that's a massive part of it, but it's not all about that all the time. You have to look at your wealth holistically. How I like to look at it from self, health, and wealth. I feel like everything in life can be boiled down into self, health, and wealth. Self meaning, first and foremost, your relationship to God, your relationship to the world around you, your relationship to your friends and your family and co-workers, the people that you work with, that you live your life with, all that kind of stuff. And obviously your relationship with yourself. I mean, the relationship, that internal voice, how you feel about yourself, how you feel about what you're doing, all that kind of stuff. That's such an important part about whether or not you feel wealthy. Wealth isn't just the numbers and things like that. It's a state of mind. It's about how you feel, how you show up to the world. It's about just your overall confidence and just like I said, how you show up and how you feel. So look at yourself, your relationship with yourself, and then your relationship yourself has to all these other things, like I said, to God, to the community, to your family, to your friends, to your co-workers, all that kind of stuff. Such an important part of being truly wealthy and looking at wealth holistically. The other part of it is your health, physically, mentally, your well-being, all that kind of stuff. You really have to have your head on right when you're investing. And I say it all the time on the show. I was really, really fortunate when I got started to be handed, Rich Dad, Poor Dad in one hand, which kind of changed the way I look at money and changed the way I look at investing and working and all that kind of stuff in general. And then on the other hand, Earl Nightingale's The Secret. I say that all the time, and there's a reason for it, because I think it's so important that you're looking at your investing journey and your life as an accredited investor in two ways. You're looking at it, I'd call it emotional and logical, but I think there's elements of both sides in both parts that I'm talking about. But you're looking at the numbers, you're looking at the data, the statistics, and you're using that to drive decisions. I think that's so important. But the other aspect of it is looking at things emotionally, looking at the team and the story and the operations and all that kind of stuff, and looking at just the way that you feel about your like I said, yourself and all that kind of stuff. So you're the kind of what you can't see, and the seen and the unseen, and how those two things operate together. So I think looking at your health is a really big part of your overall wealth. If you can have all the money in the world, but if you don't have your health mentally and physically, it doesn't really mean much at the end of the day, right? And the other part of it, obviously, is wealth, and how much is in the bank account, how much cash flow you have, and then what you do with it is such an important thing too. Kind of a greater purpose behind it. What drives you? What helps you to get up in the morning, to stay motivated when you have those inevitable challenges and bad days and things like that? What helps you to get through and to keep, moving forward, all that kind of stuff. It's just the way you show up and how you feel and all that kind of stuff. There's a lot of crisscross between the self, health, and wealth and everything I was saying there. But at the end of the day, what it boils down to is that wealth isn't just a number. It's about how you feel. It's about the way you show up. It's about the way you live your life. I call it living the accredited life. You can call it whatever you want. But that's just a quick, little introduction, as I typically like to do, and just to challenge you to live your best life and what I call, living your accredited life. So let's get into the interview today. We have a really great show lined up, very great interview with somebody doing some really amazing things. So my guest today is going to be Ben Fraser. He's the Chief Investment Officer at Aspen Funds. Aspen Funds has been around for over 11 years. They got an over 11-year track record, over 600 million in assets under management. They invest in all different kinds of asset classes with multifamily, private credit, self-storage, industrial, oil and gas. So invest in a lot of different stuff. We have a great conversation lined up to talk about all of that and more. Ben himself has over a decade of experience that includes commercial lending, underwriting, asset management, investment management. So without further ado, let's get right into the interview with Ben.
You're listening to the Accredited Investors Only podcast presented by Accredited Life.
All right, Ben, welcome to the show. How are you feeling today?
Doing well, man. Doing well. Looking forward to chat.
So it's awesome for you to be here and chatting with me today. So for the listener, could you just tell us what you do in your own words? I'm always interested to hear how people introduce themselves.
Yeah, there you go. Well, I'm a chief investment officer at Aspen Funds. Aspen Funds, we've been around about a decade plus and doing lots of different things in the private alternative sector, a lot of kind of distressed debt, purchased a lot of real estate. We also do oil and gas and have really just grown our platform, grown our funds, and continue to look for good opportunistic deals. So kind of our tagline, our kind of mantra is macro-driven alternative investments. And so what we're really focused on is looking for kind of the big picture economic tailwinds that are supporting different verticals, different strategies, right? And as investors, it's really important to know what times you're in, right? There's good times to invest in certain types of asset classes and not so good times, right? And there's different strategies that are going to benefit from different parts of the economic cycle. And so that's what we really want to be attuned to. Because, if you're a hammer, everything's a nail. Sometimes it doesn't work anymore. So you got to be able to pivot, got to have a good flexible strategy. So that's what we do. We've been doing it for a while. I have a great team. And I love what I do. Never boring day.
Yeah, I love that approach, and there's so much to unpack there. But we'll kind of start with the approach that you're taking to the business, because I think a lot of times investors, in my conversations with investors and investment groups and things like that, a lot of them, they want to see you're like McDonald's, that you do one thing and you do it well, and you do it over and over again, that kind of thing. But there's something to be said for that. But at the same time, it is different. We're not serving up burgers and fries here, and there's all these different things out there from an economic perspective, and different pressures in the marketplace and things like that drive cycles, and like you said, there's times when something's good, there's times when it's not, there's times when things are heading in one direction, times when it's heading in another, that kind of thing. So for an investor to just be able to do the same thing over and over and over again for years and years on end, it's not really practical. Years ago, I did like an apprenticeship with a local commercial broker, investor, developer, and he did everything. He would touch everything. Like, he and coming from like my dad worked at CBRE. So like, and he always wanted me to, get into that world. And it was like, you would get on the industrial team and that's all you would do. And then when I was with this guy, he was like, no, you'll eat great if industrial's hot at that time. But as soon as it's not, you're in suffer mode. You know what I mean? Like, so it's like feast and famine kind of a thing. So he really was a big on, follow the trends and stuff like that. So what do you guys, where did you get started? And then where are you today? And then what are kind of the things that you've done in order to, what are kind of the markers that you look for? And maybe another like kind of part of it is like I'm curious, are you guys operators, or are you like capital allocators? Are you investing with operators? So what's all that look like? I know I just through a lot at you, but let's take it from there.
Yeah, no, it's great questions, great thoughts. And I think a lot of people intuitively understand it because we've just kind of gone through a correction cycle, right? Especially in multifamily, right? And that's really been the primary vehicle for most passive investors as far as an asset class goes for really the past 5 years.
Yeah.
And if you were selling deals in 2021, 2022, it was a good time. But past couple of years, we're starting to see it shift a little bit, right? With interest rates going up. some of the absorption challenges and supply challenges we have in some of the high supply markets. And so all those companies and operators that were doing the same thing and vertically integrating and doing deals that, hey, worked great when interest rates were, 3 and 4%, all of a sudden can't make a single deal pencil.
Yeah.
What do you do? Right. And so there is this kind of give and this take, because you also don't want to just go and jump into a new vertical, a new strategy willy-nilly and hope and assume that you're going to have some kind of competitive advantage. I've never done something before, right? And so I think there a balance where there needs to be, from my perspective, I haven't always been in real estate. I was in banking before, worked for asset management firms before, and even non-real estate stuff. And it's so much of what I look at is this pure business case. Like, what is the actual competitive, defensible advantage that you have that no one else has, and what can you do better than other people in your market? Because if you don't have that, it doesn't matter what vertical you're in, what strategy you're doing. You probably shouldn't be doing it anyway. You're just kind of kicking the can until something goes wrong. But to answer your question, we started 11 years ago, 2013, and our two founders, Bob Fraser, Jim Fuccio, saw a unique opportunity coming out of that crisis in distressed mortgages. Right, you're familiar with this space,
Sure.
And I work for a large firm in that space, and it was a good time, right?
Yeah,
it was a good time. These notes were selling at pennies on the dollar, and you could pick them up and work them out, and usually create win-win scenarios both for homeowners and for investors. And thankfully, the tides of single family values were rising, and we were very, very bullish on that. We still remain very bullish in single family.
Sure.
And so you have the economic tailwind of strong economic fundamentals of the asset class. And then you have really good timing, right? Timing is really, really important. And some people say you can't time the market, and to a certain degree, you're right. But to a large degree, that you can understand when things are turning, when prices are coming down, when's a good time to enter a market versus a good time to be exiting and selling in a market. So you might not time it perfectly, but you can usually be pretty close. So we got into that, and it really set the foundation for how we look at the world, right? Because it was something that we saw opportunity in. At that point, it was just going to be a one and done fund, friends and family. But it really turned into a business that kept growing and became a larger middle market player. And then we've used that platform to expand into lots of other verticals with a similar approach. So yeah, we could talk about specific strategies now and how we're kind of looking at the world, but that's really how we started. And, really with my partner's experience in the different sectors.
So tell me about the strategies you like today and why you like those strategies.
Yeah. So, I'm banging on multifamily, and I think there's still a lot of challenges there for a lot of markets. I think the interest rates caught a lot of people by surprise, if not everybody, us included. And a lot of the deals that were purchased at the 4% cap rates, a couple of years ago, that had floating rate debt and very high leverage. Those are basically toast. And if they haven't already foreclosed, they're likely going to foreclose. But at the same time, you have strong fundamentals, right? So you have in a lot of markets, you're seeing, maybe not rent growth this year, but a lot of the deliveries of new supply has dropped off. It's going to kind of be going through 2025. And then from that point, there's no more new starts. So there's this kind of balance of population growth and, renter household formation, all these kind of things that drive into what, drives the rental demand. But single family prices are continuing to, remain strong. That keeps a lot of people priced out. So all that to say, I think the demand side for multifamily is a very strong bull case for the next, 5 to 10 years. I think there's no way around that. There's a structural shortage of housing. And so that's going to keep prices, or at least demand, very, very consistent and I think growing in a lot of markets. The flip side of that is there's a lot of challenges on especially high supply markets for absorption. A lot of these new properties that were developed and out in the market, they're leasing up slower than they expected. All their carry costs are much higher because of the floating rate debt. Insurance has gone up. So all these factors are driving a very acute pain in the short term.
Mm.
And so to me, there's a lot of turbulence. We've picked up a couple assets that at a really good basis. There were kind of distressed situations that we were able to come in and basically get the deal at a really good price. But the way we're playing the market right now is going down the capital stack. So we're investing as preferred equity, mezzanine debt, and bridge debt. And so we're familiar with kind of from the residential side. We've been doing some commercial for several years, but really expanding that because there's a huge opportunity of what we think are really good risk-adjusted returns where you can still play the upside case in multifamily and the kind of rebound recovery, but you're limiting your risk because your last dollar in is usually at 75% LTV. A lot of equity that you get priority over that has to get that is basically first loss before you have any potential loss. And in my perspective, there's still a lot of cap rate risk, right? I think cap rates they were super, super low a couple of years ago. They've come up a little bit, but I'm also a believer in at this point, interest rates are going to remain higher for longer and stay for a long time. And I think substantially higher than people think for a longer period of time. That's going to put a lot of pressure on the cap rates, right? And so I think there's just a lot of cap rate risk in my opinion. So when you do that, you reduce a lot of that going low the capital stack. And we're earning really good yields, current cash flow, and priority over other equity and in all these deals. So we love that. Been building out that platform. And a couple other things that I'll get into, but I'll pause there for a sec.
Well, yeah, let's do that because I think preferred equity is something that has been around, but over the last maybe the last year or two, I feel like you've seen a lot more of it. My inbox has seen a lot more pref equity deals than it ever did before. So maybe for the listener who doesn't fully understand what pref equity is and maybe why they're seeing so much of it now. And you did explain a little bit to it right there, but just speak to what it is. I mean, because like you said earlier in the conversation, a couple years ago, 3-4 years ago, 5 years ago, multifamily deals, from a regular common equity position, those deals were abundant. We almost have to try to lose money on some of those. That started to go away, and then I feel like pref equity has come out in full force. Just speak to me on why it has come out, and what is it, and why has it come out, and where do you think the trend's leading? How long is that going to last?
Yeah, great questions. I think to your point, a lot of investors, they are kind of realizing, oh, wow, I wasn't really diversified. I invested a lot of multifamily, but then what a lot of people don't think about or realize, if you're newer to investing in this kind of private real estate markets, you mostly probably invested in common equity, right? And you're not thinking about, what that means. And so if you're investing in common equity, which is what most of the offerings that you see, you get all the potential reward, right? And that's the targeted IRR that you see on that pitch deck. But you take all the risk. And if the deal doesn't achieve its NOI targets, if the market cap rates expand, and if there's any CapEx issues, if there's any, blowing out of the budgets, and who knows what's going on, right? We had a lot of issues during COVID with evictions and for a lot of properties. So what happens is you're taking all the risk with the first dollar loss. And so you could potentially have a big return, which a lot of people did the past few years when they were selling at the height of the market. But you also take in, potential losses, and a lot of investors are seeing that. And so I think it's really important to understand, am I diversifying not only in the types of assets I'm investing in, but also where I'm investing at in the capital stack. And so, we have a nice graphic, we talk about this, and I don't have it in front of me, but it's all the priority of repayment. So in most deals, you have a senior lender, they get paid first. They're the cheapest capital. And then if it's just debt and equity, you have your common equity that comes in and funds the remaining gap to purchase and finish the CapEx, et cetera. But it's been very common, mostly for institutional deals, the preferred equity piece. It's becoming a lot more common for deals that are a little bit smaller as more players are kind of coming into the space. And it's basically sitting behind the senior debt, but in front of the common equity. So you still sit behind the senior debt. You're taking more risk than a senior lender most times, but you're taking less risk than the common equity. And so you usually have priority of payment, both from a cash flow standpoint, but also from a disposition standpoint. So when they sell the refinance, you have priority of cash flow. And then in all the deals that we do, we have some level of control rights. So it's not as like, you're not always a secured lender. Sometimes we are. But in some cases, if you're not, you still have the ability to potentially take over a deal, or fire the manager, or even force a sale of the property if your covenants are not being met. So you have some control like a lender, without sometimes being secured. And so you have some of those protections, and you can earn a nice yield while doing that and still have some control over the deal. So that's really what it is. Why is there an opportunity for it? I think it's a lot of things I've been saying where because the market is going through a lot of turbulence, a lot of these properties are struggling because of high supply, high interest rates, high operating costs like insurance, property taxes being reassessed. All these things are putting pressure on these deals that a lot of times were originated with 3-year loan terms. And they had 3 years to complete their business plan, and then you got to go refinance. But they can't because the interest rates have shot up and they haven't achieved their net operating income targets. So now they're sitting there and the lender's saying, you got to pay us off. And the operator's saying, we can't. If we don't have enough, you don't have enough income to get a new loan. So what's happened is it's in some ways constipated the balance sheet of all these lenders that aren't getting payoffs from older vintage deals to then lend to new deals. So there's a huge gap of debt in the market, lack of availability of capital from debt providers, both banks and non-banks. And then on the equity side, investors are spooked, right? A lot of them have invested in deals that are not going well. They now pause distributions. Maybe they're looking at a partial or even a total loss, and they're scared. They don't want to, put more dollars in. It feels like you're putting good money after bad. But if you can buy it at a reset basis, where you're buying it at 25 to 30%, discount to prices a couple of years ago, you can get good capital in place now. That's really where it's a good time actually to get back in the market. And so we're very bullish on that. We'll probably buy a couple deals that will operate as well next year, but we really are expanding and growing our preferred equity platform because there's just an abundance of deals because of that lack of available capital.
Yeah. How do you position yourself in the market to the operators, as, hey, we're here, we'll invest pref equity, that kind of thing?
Yeah, so it's interesting question because a lot of people think we're competing with their debt providers, right? In a lot of ways, I view us as competing with their equity.
It's true. Yeah, exactly. Yeah.
We're going to be a lot more expensive than their senior debt, obviously, but we're cheaper than their common equity generally. And most of the time, because we are cheaper, we're actually accretive to their equity, meaning if they bring us in, we actually will improve the returns to their equity. Now, theoretically, their equity investors are increasing risk because they're getting further pushed out down the stack, and we have to get paid off before they get paid off. But that also benefits them because they are getting a disproportionate share of the upside if it performs well. So in that sense, that's how we're positioning from to the sponsors, operators, and then a lot of ways we can write a bigger check, right? If they're syndicating their capital, it's just harder to raise money right now. So we can come and write, anywhere, usually a $3 to $5 million check is where we're coming in at. And that could be a meaningful chunk for, a new purchase that's a, $15 million equity raise. And right now it's hard to complete that. So that's kind of where we're seeing the opportunities.
Yeah. So, where do you guys invest at? Are you, you told me you were in Kansas City, you in that area, you nationwide? Like what's that?
We're nationwide. We're mostly, I would say, Midwest. Those are markets we know well. Those are markets that are doing really well right now.
Sure.
From a rent growth standpoint. And then we will go Southeast. We've done a couple Southeast deals. We still like those markets, but very, the high supply markets, we're kind of waiting right now to see what, some of those absorption numbers look like. Cause there's still, in my opinion, some pretty high risk in the short term, just on a stabilization.
Yeah, yeah, I totally agree with you. I think supply and demand is one of those business concepts that some investors maybe forget about. You know what I mean? Like, but for us, like we do a lot of single family, and where the supply and demand metrics are great. I mean, they're in our favor big time, especially in the Mid Atlantic, where we haven't seen the massive, development boom that the South and even certain parts of the Midwest and things like that have seen. So I think a lot of things come down to supply and demand. And then you also mentioned, just the macro trends and stuff like that. How do you balance macro trends with what's happening micro in the markets that you're investing in? Like, what do you look for from a market perspective when you do enter, a certain area, that kind of thing? Just for an investor who's maybe in a state, where they need to invest out of state or they want to invest out of state for diversification, that kind of thing. I kind of like what you're saying, where you're following the macro trends, but I also think it's important that once you need to dial down on a specific area, and that area, supply and demand can vary from one place to another place, and the distances don't need to be that far. Like in Philadelphia, absorption on new apartments. I've heard from some contractors and owners there where it's like, it's not looking too good right now, for market rate apartments, brand new stuff in the city. But you come in the suburbs and they're still looking to develop as much as they can, So curious to how you balance the macro with the micro.
Yeah, 100%. I mean, I think you got to start with the macro because that creates the framework for the things you're looking for, right? Because there's so many opportunities, it's hard to like,
Yeah.
where do you stick the fork is sometime. But that helps set, we're doing about four things, or we're doing them really well in my opinion. So those are like the four things that we're really focused on, the four verticals. So that's the limiting factor. And then within those verticals, we're looking at our micro opportunities or micro markets and understanding the drivers going on. And the great thing is with all the data sources you can get, with talking with your brokers, talking with, all those in the market, you can really get a good sense of the supply and demand and what's happening, right? And, we're looking at, I want to see a strong population base. I want to see a strong employer base. I want to see population growth. I want to see a diversified enough population. And then from the supply side, I want to see, what are the new deliveries that are expected. And the great thing is that's public data. You can see what's coming in the market. Where is it being delivered to? How many units relative to population growth is it being delivered? And then, you want to look at, I think construction starts are another thing that's helpful to see, is kind of your future competition. Right now on the operator side, so we have kind of our private credit platform, and then we have kind of our owner operator platform. That is where we own and operate the units. We're trending towards the newer vintages. That's just where I think the real, we kind of do B, the B plus A minus is kind of where we like to be, 2000s and newer. And that's, of all of our assets, those ones are performing very well. And I think they're going to be well suited to capture, a lot of the people that are being displaced from not being able to afford homes. And we're looking good school districts, good locations, and places that, I'd want to be.
Yeah. Yeah. I like what you're saying. A lot of it is kind of just getting down to the basics at the end of the day, and not getting too crazy and out there, and just sticking with the fundamentals and what works. It's like practicing your free throws. I think that's an important thing, right? It's because people can get lost in a lot of the craziness, and there's so many different flavors to do this business and all, but it's like anything, you want to, especially at a time like now, like you said, man, where things have been changing a lot over the last couple of years. That's when you really need to get down to the basics and supply and demand and that kind of thing, and the trends and all. So we talked about the pref equity. We talked about the operation. What else are you guys doing? It sounds like you got maybe buckets.
And let me make one more comment on that, because I think it's important as an investor. It's so easy to get lost in the weeds, right? Is this a good deal or not? And I think if you go back to the macro supporting the micro, if you believe there is a true economic tailwind behind a vertical, an asset class, a market, then a rising tide is going to lift all boats, right? I don't know exactly what a rent growth will be next year in all my markets. I don't know exactly what absorption is going to be. But I don't have to be perfect, and I have to know directionally where they're going.
Yeah.
And if I'm in a rising tide, that's gonna benefit me regardless. And
Yeah.
so that's really where I like that, because if you have that, it's very difficult to go the other way. If you're going into a receding tide,
Yeah.
and you can operate a deal perfectly,
Yeah.
it doesn't really matter at the end of the day, because you can't fight that, right? So that's why I want to be in those tides, because they're going to create a lot of headroom, a lot of margin, a lot of tailwind that help support those deals. So we have to be perfect in our assumptions. We have to know directionally where they're going and over what rough time period do I believe that they can be achieved to make a good investment thesis. And then I know, hey, I'm going to get some extra little bit of love from the market, in this vertical, and then that's a good recipe. So
I
I'll use
love
that
that.
all the time.
Yeah.
So going to other verticals, we're very bullish on industrial.
Mm.
Industrial's been a hot vertical for decades, right? And it's really been driven by the e-commerce boom, and it's been another, probably I'd say the number two, I'd say, darling of the investment, world. It's by multifamily. Big institutional investors love it. But I think it's kind of at the beginning stages of a 2.0 boom that's being driven not this time by e-commerce, but by reshoring and manufacturing. And this is something we've been hearing about, right? A little bit here and there. But last year, $1 trillion of capital was spent in the U.S. towards reshoring initiatives. That's bringing jobs back, buying real estate, building out these facilities and manufacturing plants. $1 trillion, and that's just the beginning. You think about Trump's new tariff policies, and who knows if those all get passed, but those kind of measures and the shift towards bringing U.S. manufacturing back online,
Puts a lot of pressure for them to come back.
it's creating a huge tailwind towards the U.S. And there's so many reasons that we can go into of why that's the case, but ultimately it actually makes sense again, where it hasn't for so long. With China's wages have gone up 15x over the past decade. And then the big kind of supply chain issues we all experienced during COVID, right? A lot of these companies realize, we've kind of over globalized. We've become too reliant on the supply chain that we can't get critical components in our manufacturing process that basically don't allow us to sell our end product. Like Ford is a great example. During the height of COVID, they had, I think it was $4 billion of completed inventory sitting in parking lots that they could not sell because they didn't have the computer chips that were, a couple $100 computer chip to put into this vehicle to then actually go sell it. And so it was stuff like that all the time, where that's just become part of the calculus now for companies. So anyway, the industrial market's interesting, where it's, if you think about before, is really get into the gateway markets, on the coast. Where you're at is a great example of that. That's still, I think, going to be a strong case, but if you think about the use case now, it's shifting from pure distribution, gateway markets, from bringing in goods from other countries that are, sending the product over here for us to buy. It's now shifting partly to distribution and manufacturing, which is a lot more Midwest and a lot more South, where there's just better blue collar workforce. And so what we're seeing is a shift to the use case of industrial, and also the size. So a lot of these, if you look at the market in general, there's a little bit of vacancy sitting in the market. It's not substantial. It's about 6% nationwide, not a huge number.
Yeah,
but if you
industrial.
bifurcate that, if you bifurcate that down by size of property, anything around 100,000 to 200,000 square feet and below, there's almost nothing vacant. Right? These smaller properties is where the real demand is. And most of these really big 500,000 to a million square foot properties are sitting, that we're kind of waiting for, the e-commerce and the big warehousing companies to come take them over. And those will get absorbed at some point for sure. But the real growth is in small properties. So we're developing a lot of these types of smaller properties and good markets with good blue collar workforce, and then building them for multiple use cases. So whether it's for manufacturing, for distribution, for warehousing, any of those use cases we can facilitate and have a flexible business plan. But it's been a great vertical. We're very, very bullish on it. And then yeah. Our other
that's a fascinating explanation of it, and puts things into perspective, because here in the Philadelphia area, I was very intimate with industrial about a year or two ago, and it was just white hot, just unbelievably white hot. You couldn't get anything. The pricing was baked into the market majorly, and those cap rates were historic lows. Industrial owners, unless they were living under a rock, knew that they were sitting on a gold mine. But I like what you're saying. So I think it cooled off a little bit. But I like what you're saying about kind of industrial boom 2.0, because one happened, and now, and like you said, it was after COVID, it was right at the tail end of COVID and stuff. And, maybe I guess during COVID as well. It was those drivers with, getting things from here to there and the distribution and stuff like that, to now what you're saying about manufacturing and all, and bringing things back on shore, which is very interesting, because I love industrial, but it was something I've somewhat back burner, because you just couldn't find anything in the Philadelphia area that, and there was firms that came out and with big institutional backing that acquired everything around here, and have been able to redevelop. A lot of development firms creating new, and it was that if you build it, they will come mentality, and they're still coming, so, but very fascinating to hear kind of what's pushing that next evolution of industrial. And because I think for a lot of investors, it's something they should be looking at. I think, like you said, multifamily has kind of been the top of the food chain for passive investors, probably because I think podcasts and events and all that has pushed it so much. Bigger Pockets is really heavy on the multifamily side and stuff like that. But I think going beyond that, in the last couple years, probably should have forced you in some ways to start to look beyond it. Industrial is a good place to look. It's yeah, so I love what you're saying about that. What's the other? Is there another bucket too? Or
yeah, the other bucket is oil and gas. So also another, another vertical that we think is really, from a macro perspective, we believe is a generational buying opportunity right now. It's kind of nuts. If I was going to just put in a few simple bullet points that we can dive in, it's fossil fuels are bad, right? With the whole shift to the ESG initiatives, environmental, social, and governance standards. What's happened is they've been forcing these standards on capital allocators to have to hit certain scores of their capital being in green initiatives. I'm all for green initiatives. I think it's important. I think we should continue to push the envelope on trying to get new energy sources. The problem is that the benchmarks that are being set from all these energy agencies and all these transitions to being 100% green, they're just not realistic, and everybody knows they're not realistic. But they're not thinking about what's going to happen in the transition, right? Because what's happened is, as they've been disincentivizing investment in the fossil fuels, they're basically shooting ourselves in the future foot. Because if you think about fossil fuels, it's a depleting resource. So every time you pull oil or gas out of the ground, there's less of it in the reservoir, and every year we deplete about 5% of our current production. So it requires consistent and continual investment in CapEx and exploratory drilling to continue to pull more fossil fuels out of the ground. Well, guess what has happened to development in fossil fuels? It's fallen off a cliff.
Sure. Yeah.
It's dropped by about 50%, 50, over the last decade. And if you think about the timeline, similar to like construction starts in real estate, or a predictor of future supply, this is also a predictor of future supply, because it's a long sales cycle. It's or not sales cycle, a long development cycle to go and get the permits, do the drilling, build the infrastructure, be able to actually get the capital to go develop it and pull it out of the ground, and then sell it to market. So there's a multi-year process generally when you just want to start doing more drilling. So we're very bullish on long-term prices, both for oil and gas, especially oil. And we think that our thesis will play out over the next probably 5 years, but potentially 10 years. Who knows how long it's going to be? So we're building a long-term strategy for taking advantage of that. Now, in the meantime, that's the long-term economic fundamentals, right? But in the meantime, because all these allocators have pulled out of the market, there's not much cash. So all the big institutional players that were buying, all these, all this production, all this drilling, they're not there anymore. And so it's mostly family offices, and then some private equity is still doing it. And so we're buying right now. Our strategy is to go buy existing production and then add drilling on top of that. So it's kind of like a value add property where you're going to go buy existing cash flow and you improve it to increase the value over time and then sell it. So our strategy is very similar. We go buy existing cash flow and then we go add drilling on top, because you usually get rights to drill more on the mineral rights that you participate in. And we're doing this alongside major operators. So we can go invest in what's called non-operated working interests, and we go and invest alongside generally publicly traded companies or very large operators that have been doing this a long time. So we're not taking a lot of development risk. We're not taking a lot of operator risk, and can get into really nice, big, proven basins with horizontal, institutional level types of wells. So we're buying existing production at about a 20% cap rate, so 20% cash on cash unlevered, and then we can go and invest additional capital into drilling and get anywhere from a 30 to 50% risk return on the drilling. So it's a great time to be in oil and gas right now.
Yeah, good.
A heck of a lot more.
That sounds amazing. We could probably take any one of these topics and really dive into them. But for time purposes, we'll save that for another day. But tell me, how do you work with investors? So, I'm assuming you have multiple different offerings depending on the buckets, but curious to hear how you work with investors. How if it's funds, if it's syndications, if it's a little bit of both, or what's that look like?
Yeah, a little bit of both. Most of what we do is funds, hence Aspen Funds. But yeah, we work with a lot of passive investors. We work with small family offices, some institutional investors, and but really try to create a really easy on-ramp for accredited individual investors. That's our passion, is to serve that clientele. So we have, I think, approaching 1,000 individual investors in our funds, and expect to continue to grow that over time.
That's amazing. You guys have done a great job at branding. We were talking about this beforehand. I've seen you guys around for a long time. And what would you say you're doing there? Like, what's on the fundamental side? What would you say you're doing to create relationships with investors and find prospects? I think one of the things the internet, like social media, has done with raising capital over the last 10 years is it's made things more accessible, which is good, but also bad because it brings a lot of competition in, and there's more like fund managers now than ever before. It's like the new fix and flip. You can go to a weekend seminar and become a fund manager. So it's like Facebook, LinkedIn, like I get hit up all day, every day from fund managers. So what do you guys do to stand out in the crowd and generate leads, and then make those leads bring them into the Aspen Fund family there?
Yeah, I mean, that's probably a whole other conversation of itself, but it's kind of interesting, because I would agree. We've been in like the syndication bubbles, I've been calling it. We've had a little bit of a mini asset bubble. We've had a major syndication bubble where everyone and their mom thought they could raise money and buy real estate and just print returns. That's not the case. That's where a lot of people are finding out. So I think being an operator that's a legit operator, that has a legit operation, we have 30 plus employees, that has been going a long time. At a certain point, if you just continue to survive, I think survivorship is actually a calling card, and have a decent track record. That definitely helps. And at the end of the day, just being in business, we've been around for 11 years. I mean, that's a long time, and people just hear about us. And I wouldn't say we're doing anything fancy or anything special. We just try and serve our clients really well. And what that does for us, our whole model is, if we go and get a new investor, our goal is that they don't invest with us just once. They invest with us a lot, because we're performing well for them. And they want to invest with us because they like what we're doing, and they get our thesis. And then, hey, hopefully they'll send a couple friends over our way, because we're doing well for them. And, rich people know rich people.
Yeah.
And that compound. So honestly, about 75+% of our capital every year come from current investors and referrals. And then the rest we kind of meet at different conferences and podcasts and advertisements, other things that we're just, doing. But for the most part, it's just blocking and tackling, having those conversations, getting to know people and getting to know their networks and just trying to do well for them. I think honestly, it's a competitive advantage just to serve your investors the way you want to be served, because a lot of people aren't doing that. And if you do it for a long period of time, you're going to stand out, which is, surprising.
Yeah. Yeah. Now you hit the nail on the head, and it goes back to the fundamentals, like we talked about with it sounds like you guys have solid fundamentals on making investment decisions. It's the same thing on the investor relations side of the business. There's core things that you should be doing, and it sounds like you guys are doing it. And coming from a company that being on both sides of the spectrum, where I was at a company that had been around for a while, like you said, surviving it means something at the end of the day, because not everybody survives. Some investors just kind of have that criteria that, like they want to see the company around for 10 plus years. So you guys check that box. And then I always, coming from a company that had been around for a while, my concern with companies like that is always, how have they evolved over the time that they've been around? Because chances are when they started, the market was totally different, and they started with a certain strategy in mind. And when it comes to that, you guys are, it seems like you hit the nail on the head, because you're doing the right things to be constantly evolving with the market. And it sounds like you position yourself in the right way to evolve with the market and the trends and stuff like that. Because I think that's the most important thing. The longer you've been around, that can make you or it could break you, because it's like, because you're building your team out around a certain strategy, things change, something like that. So I love what you're saying there. That just, it makes a lot of sense. And so for investors that want to get to know Aspen Funds more and learn more about what you do and yourself and the company, that kind of thing, how can we find out more about you?
Yeah, sure. So you can check our website, aspenfunds.us. We also have a podcast as well called Invest Like a Billionaire, where we do a lot of kind of education for passive investors. Those are two great ways.
Cool. Awesome. Well, Ben, thank you so much for being here. I could have talked to you all day about any one of these topics. Appreciate your time, and hope we can stay in touch in the future.
Yeah, absolutely, man. It's really fun. Thanks for having me on.
Thank you.